They will never let you have your own money. Their goal is always been inflation so that they can debase your money. That keeps you poor and keeps you having to run on the treadmill faster. And they're going to say it was all Iran. It was all, we had to deal with a nuclear threat. It was the cost of dealing with the nuclear threat.
Francis Hunt, technical trader who called gold's move from $2,000 to $3,500, sees what's coming. The biggest bank crash in history, engineered to push you into digital money they control. And he's warning, get out of the West while you still can.
But right now is not a good time to buy, because you're about to experience the single biggest bank crash, the withdrawal of consumer credit. You should leave. End of. I am expecting.
Quick note before we continue, 85% of the people that are watching our episodes are not subscribed. But if you do enjoy the conversations with the smartest people in macro, finance and crypto, make sure to subscribe to this channel because it helps us a lot. Now let's continue with the conversation. Francis, welcome to the show. Before we start talking about all the complexity of the markets, and I'm so happy to have a trader on the show, how much fun is it to trade with the volatility that we see?
It's certainly interesting. In fact, my favorite moment, Mikhail, is just before the expansion of the volatility. Right now, for example, on gold and on silver, we're not active. We were fortunate enough to get out before the smashdown. And we had one small little reflation mini trade in there, but the macros stalled a little bit now between, if we're talking about gold, in the 5,644 zone. We are waiting to see, we're waiting for it to calm down and set up a continuation pattern. So the manner in which we trade is pre the volatility into the volatility. So our methodology is asymmetric reward to super tight risk. We get in on the very low volatility when everyone else is bored and is saying, oh, market, you know, with a Bitcoin meme with the guy with the stick poking Bitcoin and nothing's happening. That's very intriguing to us, because that's where you tend to get continuation. That's where you get very low stops that will survive, low, when I say low, tight stops, and that allows for expansive moves. We've done that now with the USD Korean won, which is maybe not the most interesting topic, or maybe it is. I feel it's all part of Iran, the Straits of Hormuz, and a particular nation that's very exposed on its Kospi to the AI boom. And as a result, I'm expecting higher interest rates. I have always positioned for higher interest rates. They need higher interest rates because there's too much fiat and debt. And so to me, this is an engineered event. There is no shortage of oil. This is a supply chain engineered bottleneck that can see them to varying degrees. They can open it and close it. Apparently, you know, yuan paying oil tankers and are being allowed through. So they can throttle and punish certain nations. And I feel, and as I've always said, it's the Western nations that are going to get punished. We have the highest income per person per capita compared to the rest of the world, and we are going to re-rate it down and taught a lesson. It's our time for a Bolshevik revolution in the West, and I've continually to advise people to locate themselves outside of the West generally, and suggested also that their money should flow from west to east. It will be safer, and that some of the biggest crises and failures and frauds are about to be exposed, and they're going to be Western of nature. So my current trade is a recent expansion in volatility across 3 or 4 time frames, and I'm happily show it to you. And I do think it benefits from all of these events, because I think China's going to do okay because they'll have special agreements with Russia and Iran, but smaller Asian nations that align themselves to the West, Japan, South Korea, are not in the China club, and are going to find themselves out on a limb without the US protection. And in fact, America has moved the North Korea, South Korea border THAAD missiles that were defending South Korea to go support Israel. So there is a withdrawal of American hegemony from the world, and they are going to focus on the America's line and Israel, And in the end of this, whatever happens in the Middle East, I think either their bases in the Middle East will be destroyed or handed over to a greater Israel project. So my geopolitics might not agree with everyone, but that's how I see things going. And I see a much higher cost of living and inflation coming. And I see bonds being rebased downwards through the interest rates hikes, because that is what we need. We are in a fiat and debt bubble. Before, everybody says the everything bubble was only facilitated through fiat and debt excess proliferation. So the thing that most needs devaluing are the fiats and the debt, and the way you do that is inflation. And this is the engineered inflationary solution.
If you mention that you want to position before the volatility happens, then there are two ways of markets kicking out people out of the market, which is one, price goes down, and second, time is moving and nothing is happening. And that's kind of what we saw with the fact that Bitcoin as a price action didn't move in the last, let's say, year or so, same with other cryptos. But it's the same for a long period of time for precious metals. Gold hasn't been moving for years, and then all of a sudden it starts to take off. What made you decide to go into that trade just before the volatility kicked in and everybody wanted to rush into that position?
So we started, our methodology is called Volatility Funnel. The key word is volatility, and then funneling is the compression. So we get into markets on extreme compressions. You mentioned gold. There was a key entry point where we said gold is about to start moving in an unheralded, open-ended way, and is going to do well over 50% and go well beyond. And that was in and around the tail end of 23, beginning 24. And we had a squeeze, and we already had a macro continuation pattern on a very large time frame. So maybe I can describe that. I know you have listeners as well that may not get the benefit of the visual, but for those that do have the visual, I'll do the visual for you. By the way, you mentioned that you had Bitcoin, so I did a quick check and put on our draw tool on Bitcoin. You had an inverted HVF structure right here on the short time frame, just as a little bit of an alert. There it is, 3 impulses up and down, and then a smash and real overperformance to the downside. So you've fallen from a high of around 76, you had a correction down to here, and you now have a little bit of a head and shoulder structure over there. That's what I was looking at just before starting, because I understand you have a crypto audience. So it's a little bit sad for Bitcoin. But let's go up to a bigger time frame and show you guys that gold question that you raised. And it was here was a classic case. We like to stack multiple time frames into existence. By the way, in case you were thinking the gold guys are getting smug by calling out the Bitcoin guys, gold also sold off on a similar pattern, and you can see the breakdown here. Not quite in percentage terms as much, but the 5,000 level was a very key level, and it's dipped below on the 5,000 level as well. So you've seen a little bit of the supposed reserve assets take some heat in the last few minutes. But I'd like to show you gold on much more serious time frames than on the small time frames. That was, by the way, HVF method, and I just showed you 2 little draws there. And we think you can pull down the overall on gold, just in terms of the short term. You've got a defined range there and there. Everything inside this range is going to be, I suspect, continuation until such time as we break that. Then we're into a more severe reversal. So we can come down right the way here and then go back up, and this can all still be HVF volatility squeeze. You can end
What's
up with
that
a
price
pattern
level
like that.
that you're looking at on the downside?
Say again?
What's the price level on the downside that you're looking at in this entire
So
range
it's
on gold?
the low of the hammer and the high of the shooting star, 5, 6, and 4, 4.
So
that's the
kind of in
defined
the
range.
same way. Yeah, that's kind of the same methodology on the short term that could be classified as like a mean reversion play, where gold is a little bit overextended to the upside. So in the short term, it needs to find itself into a new fair price. And then the lower boundary for you is kind of the area around 4.4.
Yeah, and we think you're going to bounce around and not do anything particularly significant to the upside or break out the downside for a while. But we had three after. So here's what happened. We had the shooting star, which is inherently bearish. You'll be familiar with a candlestick pattern, the shooting star. So that was bearish. The way you negate a bearish thing is you do the exact opposite to the downside, which is a hammer. So it found its low and it bounced back up. But now you've gone one way too far. You've overreacted downside too far. Now you're in this float zone where it needs to just, on balance of probabilities, in our opinion, just calm down, and you get a compression of the volatility. And our inherent suspicion is at some point we'll be trading upside continuation again. However, we don't know that, and we accept we're wrong on that bias to bull, because that's your trend. We accept we're wrong, and we're in for a deeper pullback if you trade through 4-4. So yeah, that's a little bit like where we are. But you were asking about something else. You were saying gold. How did you know it would start moving? And I'm going to refer you to this area here. We had a very strong bull pole. And then we had this broadening structure, which is typically continuation, upside continuation. It's a broadening structure with an inherent decline to it. So you see the splitter. This is essentially capturing the gradient between the flat top, which was 2000, just through the 2000 mark. So you almost made 2000 there. You traded a little bit above, a little bit above, a little bit above there. And then you had these descending lows. So you had a bit of a broadening structure. You were winding out and shaking out the volatility that way. And then when you had this last up leg, instead of going all the way down lower, the volatility was now reducing, and you only made the splitter, which is the halfway mark, and then you were back up top. So that was starting to lean against what we'd call the ceiling, the carport. That was the line we expect to have broken when we have a descending megaphone. And then we dropped time frame. So that was showing you on the weekly time frame. If I just go back to 2024 on the daily, go to 24 and do it on the daily. So we go some point in January. This will show you that we had, on a smaller time frame, another squeezing structure. So you had that ceiling that I was describing that was in and around the 2000 level, running like that. That was the level we expected to break. That was the bounce on the splitter. That was the splitter of the descending megaphone. So it didn't go all the way to the bottom. It bounced on the halfway mark. What you had on a lower time frame was a constriction and going very low vol over here. And we would refer to that as the funnel. So you had, again, one impulse. You had a complex extended second impulse, and then you had a short third, and that was the break for gold. This is a volatility compression, and again, continuation to the upside. We expect the high side level to be broken. So we had a price level that was flat, that came from the broadening structure, and then you do what I call, on a lower time frame, a fractalization of a smaller pattern that's leaning up against your break. So on the smaller time frame, this allows you to get a much tighter stop. You can have a stop there, and you can get long there, and you would have then had that level of risk. And then the reward came all the way to 3,000. Why 3,000? Because we had that pole projection to the megaphone projected up, which was a 50% move in essence. And not only did you do 3,000, you went all the way up to 3,500 in the end. And you can see along the way, you made further volatility compressions, which gave multiple trading opportunities, till eventually you got the blow-off of Trump on the Trump tariff tantrum, which came during April. They called it Liberation Day, I think. I'm not quite sure what got liberated there, apart from the gold price. But it had an excess overperformance. You can see this move here was getting a bit blow-off like, and then you had a captured down. Again, you got a complex second, you got your third impulse, and then we were going long again. In the end of the English summer, I was even live streaming from Hyde Park in London, walking about and saying we're expecting the next leg. And that turned into a very good move too, which if I pull it down, you can see how steady it was, how low volatility it was, just steady, 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 all the way consistently climbing up. That was just beautiful trade to participate in because you really didn't have many adverse days at all. And then what we call the first slap in the face came, grind up, and now the momentum was becoming a little bit more grindy and slower by nature. So if I just get a bit more of the real estate in there, you can see to start, you were going up very steeply. This is the value and the gift of trading breakouts. You can see afterwards it was a little bit lower and also a little bit more volatile. You got a second slap back halfway up. Then we had the full blow off and the slap in the face. So we're in a little bit too much volatility. You can see the volume is big. These are fat candles. You might notice the fatness of the candles. Let's get the whole chart in. And that's high volume, and high volume is usually meaning the volatility is still a bit skittish. You need these to drop off. They are starting to get skinnier. This could have been a rising wedge. It looks like it. And now you're rolling over. We've let go of the 5-1 and we've let go of the 5,000 that was forming there. So you're still in range for gold, the 4-4 and the 5-6 with the 5,000, the 50% in the middle. But you're now in the lower half of the 5,000. So to me, there's not much of interest in gold right now, even though macro, and I'll explain why, we're very bullish. And on silver, macro, we're very bullish. It just made on silver our second interim target on a big HVF setup. So once it ran the 95, it actually traded to 120 and has had a big hit back. But after it gets over this phase, we see 333 and well beyond.
Before we continue with this episode, I would like to show you something really cool, which is that our partner OKX has announced the OKX card, which is a digital card which is fully into your account on OKX, where you can just use it for any buys that you do if it is connected to MasterCard. So it can be your groceries, it can be flight tickets, anything you want. And the cool fact is you can actually get up to 20% in cashback until the last day of this month. After that, you're going to get 4% in cashback. But everything you buy through the app this month, you will receive up to 20% in cashback. And then on top of that, you're also going to get up to 100 euros in Bitcoin. Find the link in the description below and sign up today. Now, let's get back to the episode. I know that you're very technical and very data-driven, which is, I think, the best way of approaching markets. But how are you assessing all the geopolitical, macroeconomic events that are very likely moving markets in a direction? I mean, the entire situation in the Middle East has started, and since then, gold has been going down a little bit because probably the event was priced in. Bitcoin did the inverse. There are a lot of factors taking into account, and you mentioned that you're macro-wise very bullish on gold. But for someone who's listening to you and is seeing the entire technical aspect of the markets, how do you take into account of all the events that are taking place?
So there's a lot of theater, and at the very highest level, my framing is the world is coordinated and run broadly, all nation states, by we are already in a new world order, if you want, a global managed environment. As I mentioned, even Iran had CV-19 injections. There's a sort of compliance at a very high level. They need inflation. So you compare the stagflation era of the 70s to today. The only thing that's different is there's lots of things that are different, but there's lots of things that are similar. We are just in a far more extreme indebted state. If you take the timeline from the creation of the Federal Reserve in 1913, you have 1971, and then you have 71 to 26. You were limited by how much proliferation you could do, the rate of ascent here, by the fact that you were fixed to gold. Of course, America started cheating and doing excess engagement in the Vietnam War, the military-industrial complex, etc., so that it could overspend, and there wasn't backing of gold, so the French asked for the gold. They were caught lying in 71. So from 13 to 71, you were kind of a little bit restricted in fiat proliferation by the need to have gold on your books before you could print more money, because it was all convertible by gold. But they never had the amount of gold that they were supposed to have for the amount of fiat and the borrowing they were doing. Once gold was removed, the fiat proliferation is just gone absolutely, it's off this chart, on this diagram, to 2026 that we find ourselves in today, which is 26. So there's my Greek 6 for you. And as a result, we're in a hyper stagflation rather than a standard stagflation. One of the reasons that is America was at about 30% GDP in the 70s, and in the right up to Volcker's tightening of rates. He could go that high on interest rates because there was a certain amount of debt about, and he could devalue that debt. The problem we have today is that the volume of debt is unbelievably larger. America's at 135%, and if you take unfunded liabilities, they're closer to 550 and 600%, well beyond Japan with unfunded liabilities included. And that is Triffin's dilemma. They export their paper, which is debt bills and dollars, while they consume excess goods from imports of producer nations. That's the Triffin's dilemma. So what is happening here is that this is so vast and so huge that we won't have. I'm a bit surprised by the number of people that say we're going to get $300 oil. We're already in a recession, probably a global recession right now. We're facing a downturn and an absolute fraying at the edges of the credit markets, starting with the worst credit. That's happening, and it's rolling into a contagion, so much so that they're blocking people from doing redemptions, and they're not making a price where it should be on the private credit. So credit markets fail from the fringes. And at the same time, you have so much credit proliferated that you don't have to have, you couldn't go the same height of rates that you had during the Volcker era, because we'll have bust long before then. And in the same way, oil can't go to $250 without us first busting immensely before. It can go 250. I'm not saying it never can, but I'm saying that the response to the economy will have, if it did that, is you will all be locked down or shut down. It'll be another similar CV19 event, only this time it will be, hey, the supply chain isn't working, Straits of Hormuz, it's the Iranians' nuclear thing that did this. That's why you can't drive your car. That's why you can't. They can maybe get oil up to $250 at that level, where very few people are driving, buying goods, paying for packaging. And then still you will be in a worse recession than you are now. So even a sustained period for me at $125 to $135 oil in this current economy is going to be devastating and deflationary, and deflation quickly fixes the oil price because everybody is bust and starts to go bankrupt and businesses shut down, and then there's no supply. So that turns into a real problem that quickly corrects oil prices. It doesn't correct gold prices in the same way, because they've created so much debt that if you were to be backed by a gold for all the debt, gold should be immensely higher. So a lot of people tend to put oil and gold as synonymous. Oh, they're both going to go up. In inflation, they both do go up, but gold has an open ceiling to how far it goes. Oil is a consumable that is an empirical consumable to everybody's existence. And the minute it gets too expensive, the world stops operating to a large degree. So there's a couple of thoughts for you there, as well as the gold setup that we discussed. So let me hand back to you.
A few of the things that you've mentioned before diving into those, the first thing that I wanted to discuss is that I listened to a different podcast where you mentioned my country, which is the Netherlands, with the unrealized capital gains or gains tax of 36%. What advice would you give to fellow Dutchmen and ladies if this is going to be applied?
I'd shock you with how many Dutch people are here in Cape Town.
Yeah, I know.
They're absolutely everywhere. Only probably outnumbered by Germans. And more importantly, they're also buying properties here. The cost of living, the quality of food is actually significantly better than generally Europe. I'm not knocking the beautiful Dutch country and many Western countries. South Africa, don't get me wrong, has its problems. I don't participate in the politics. It's a dumb show. I don't stay here longer than 6 months. I'm not suggesting become a tax resident here and a full-time resident here, but you can certainly live just under 6 months here and avoid being tax resident and have better standard of life, better weather, better food, and quite a lot of better. Are there some trade-offs? Some will say, crime and security. It depends where you are immensely. Anybody who knows anything and is in the right places should not be feeling unsafe. But, farmers in the north part of the country, particularly as a politically targeted group, do definitely feel unsafe. So, you make your own choices. Come and have a holiday, decide for yourself. I'm not here to sell where I live short term, but I don't stay here all the time. A, because of residency. B, because of I want to keep optionality. So our whole raison d'etre is build wealth during these times, protect that wealth, and have jurisdictional optionality on all your plans. Because there is variance across borders. Even though at the same time I'm saying the world at the highest level is synchronized, there's still arbitrage. The COVID experience in winter in a high-rise apartment, let's say in Amsterdam, versus the COVID experience with someone with a large, single-story, massive plot farm here in southern Africa, close to the beach, is totally different. And how it would have got you down and how you would have lived it out is totally different, even though they both had some degree of lockdown. So my opinion is have optionality that allows you to choose the best. You'll always have intelligence, you'll have WhatsApp groups, how's it going there, what's happening, and you can decide where you want to see something out. I do feel our freedom of movement is going to be deeply impaired. We're going to continue to be surveilled ever more from cars, TVs, you name it. Everything is selling your data now and is spying on you on all aspects of your life, in fact. And dataizing it, selling it, and also handing it over to dark state entities whose goal is to remove all privacy. And the long-term goal is actually to remove all your assets. So tokenization is an interim step. It's a digital clipboard for capturing that which you own so that they know they can strip it all off you and that you now no longer have anything. And unrealized capital gains, which is where the question started, is actually a denial of property rights. Because by the time you can insist that someone has made money before he's even realized that money and is therefore owing you a tax bill before anything has been realized, you're enforcing him to be a seller to meet a tax bill, which means you'll either partially sell or entirely sell to meet an obligation. And you're putting him in a position where the assets have to be foregone. And that money will be then paid in taxes and other things and another wealth tax. And so you whittle everyone down. We have to remember that it isn't a capital gains. The fiat's devalued. It's debased. In gold ounces, it's not gone up. It's theft. It's all theft. The entire policy of central bankers of inflation is fiat and debt debasement. Therefore, you haven't gained. You should be allowed to measure your assets in gold ounces, and actually you should be booking losses on your home. You should be booking losses. You bought it for 150,000 euros, you sell it for 500,000 euros, you should be booking a loss because gold in that time's gone 6 times up, not 4 times up. You should be booking a capital gains unrealized, a realized loss, and you should be getting payment, not being made to pay. That's the court case in the financial Hague that must be won. You don't get to tax me out of my assets when you've debased the fiat and it isn't a capital gain in the first place. It's theft. It's full-on theft. It is removal of property. by virtue of aggressive legalization. You get legality and you get morality. They will write laws to strip you of your assets and make it legal and make it just and make it moral. They'll create divide and conquer across race, across class, across income group, so that everyone else cheers that you get shaken out. And all the dumb normies, the NPCs, the mask wearers, the people guilting people out for not taking vaccines, all those guys will be cheering that you get forced sale, so that you're a crab in the bucket. The last thing they can afford is that any of their citizens escape and they get shown up for their lack of preparation, their lack of critical thinking, and their overall contribution to a global communism through a corporate fascist state. That's where we're heading. It is absolute, puts me into rant mode, this topic, and it is about as triggering as I can get. Everybody needs to push back so hard on legalized theft of assets. That's what it is. It's a stripping of private property. If you can't see that you're going to be stripped of your private property by a law like that being passed, you won't see that you'll be genocided next once you're a hopeless mouth sitting in a nest waiting to be fed because you're stuck on UBI and worth nothing to you, and they've fully replaced you with robotics and AI. In some instances that'll occur. I'm not of the opinion in all, but you will then be worthless to them once they've taken everything off you. Look at your Bolshevik history in Russia. Look what they did. They slaughtered the Christian orthodoxy in the most vilest, cruelest way, and they targeted the principles, the religion that spoke of value, commandments, manner of conduct, all of that. It is spiritual. This is war, takes it into a spiritual realm. You really need to get angry, way more angry about this. I don't know if they pushed back enough that it's been circled away for a while. Wait
Actually,
yeah.
Actually, the people have been getting angry about it. So at least they have pushed it back, but they've pushed it back in such a way that it's going to be redesigned. So the path is quite clear. And for me, especially my generation, and a lot of my generation from Amsterdam and the Netherlands are coming to Cape Town to escape the winter, but are actually moving out of the country. And it's stimulating myself to get away from Western Europe and go to a different country on so many levels. It's not only the tax reasoning, but it's also the safety and security in Western Europe, which is just declining, which is a completely different topic. But I completely agree with the view that you have. What I wanted to touch upon is the fact that if you look at the charts, and you mentioned that you think that the interest rates are going to go up, Trump has the opposite idea, and Kevin Walsh perhaps has a different idea too. What I see in the charts is that the interest rates have been breaking out of a downtrend since the 80s. After like 46 years, we start to break up. It's very likely that we're going to have higher interest rates for longer. But I wanted to pick your brain on the contrary view that we have in the markets right now, why you believe the interest rates are going to go up.
So we were the first to say interest rates were going to go up and that debt was to be debased in the late 2020. Around about August, September, we called it on the TLT, which is an ETF of long dated debt, 20 years or more in the US, and it was 100% accurate. You can see that chart. This was well before Druckenmiller and Paul Tudor Jones declared their positions in 24. So they probably put the positions on, that was the end of 24, during 24, to profit out of it. They'll of course have much more access to leverage, and they'll make a lot more money probably than we will by scale, but they were way later than us. And we saw this technically in the charts, utilizing HVF method. And since then, we've went on in 21 and looked through the Japanese, the European, and we went through every single debt market, and we concluded that technically all the debt markets were going up, including Australia, for example, which had a particularly good setup and is ripping at the moment. So we've seen this, and we've said higher for longer. Pullbacks will be short. Don't forget, they had you all believing that Powell was being kicked out by Trump, and that you'd have some dove coming in who was going to cut rates. How does that sound now? We said it's not going to happen. It's not going to happen. Something's going to happen, but that ain't going to happen because rates have got to go up. All the technical setups are showing going up. The minute you're below 4%, we're saying it's going to go higher from here. And what happened? Hey, we started a war, and that seems to have changed things. Oh dear, now we're no longer talking about rate cuts anymore. Boom, all of a sudden. And what are they going to do? They're actually going to escalate that far further. So this is the setup. They've shown you what the setup is. They're going to squeeze supply chains, and they're going to push the prices up for everything. That's it. They need an OPEC of the 70s. The OPEC was needed. The petrodollar relied on the OPEC. It is part of how it was constructed. They used oil, they made supernormal profits to squeeze everybody's prices up and cause inflation across the world. They made you poorer. They made your mother poorer, your father poorer during that time. I remember those times. I remember it's hard. I got shouted at. You couldn't lose your school jersey. It cost too much to replace. Yada, yada, yada. Everything was expensive. Incomes were low. They were lagging the real growth because of the high inflation rates. And that's how they destroyed the debt. And then Volcker came in and upped the interest rates. All during that time, gold ran until Volcker reached the peak on rates, and it absolutely killed the debt market so much that getting 16% on a bond was now a pretty good deal, and they looked cheap. You had to get to that point. But before that, they were, so imagine the losses on the debt. Now you have a far bigger debt pool, infinitely larger debt pool. You need a sustained period. They would have had to compound low real and negative real wages for decades to work that thing off. They don't have the patience. They want to staircase this. So a big spike, create an event, spike the rates, do a major loss on the value of that debt, start getting it way more manageable far sooner. And that's what they intend to do. So, and all your pensions that hold debt are going to crash. All your housing markets that rely on lending, you're going to get less lending, far more expensive with much larger deposits required. What does that do for your property prices in Holland? If you're a Dutchman right now, as far as I'm concerned, I'm selling up, I'm renting, and I'm buying houses in call it the third world if you want, and I have a stopgap home which I can ad hoc rent or Airbnbs. You can still go back to Holland. You can still see your friends. Believe you me, they're going to be telling you things have got worse. Every year you go down there and you look like you're having a better life than them. So that's what I'd be doing. It's why I have homes in Georgia, Panama, and South Africa. Everybody goes, that doesn't sound very exotic. They prefer the sound of Monaco, Paris, and London. No, and no. And New York, no, none of them. I don't want the West. I don't want the West in any part. The West has been highlighted. The Straits of Hormuz, apparently they're letting, tankers that are paid in yuan go through. China will do okay. China is looking after and propped up Iran. The westernized East nations of South Korea and Japan chose the wrong team. They shouldn't be with America and Europe. They should patch up relationships with China and North Korea and all the other Asian nations, Thailand, Philippines, and, recognize their lot, because then they could get looked after a bit better. They, at the moment, are a stranger in a strange town being out there, and we see big downfalls for them and potential further inflationary costs. They also have the worst demographics, 0.91 and 0.88 for South Korea of replacement population per couple. They have real problems on pensions. This is going to be a big issues. And the debt markets the world over is desperately being supported. The pension scheme in South Korea, as an example, the national pension scheme, is overinvested domestically and is overinvested in their local bond market to support the won. Buying their own debt supports the Korean won. Debt and fiat are synonymous. One is money and the other is money with a time frame attached to it in a rental agreement. That's it. They're both money. The bond market can't crash without the fiat crashing. That's your inflation. And people need to understand that. That's what happened in the 70s. And that's why people were poor for a double decade. Stock market went sideways in nominal terms. In real terms, it was actually rebasing down. The dollar was getting weaker and weaker and weaker, yet the stock market still went sideways. From the late 60s till 1982. The bull market started in 82 after Volcker had crashed rates right up, and they started to definancialize gold in the precious metals. We've got to go that same cycle, only in a far more hyper extended basis, and they are going to drop the digital surveillance grid on us. and all their, hey, the world has to operate like that, we need UBI, you can't be rich when other people are poor, this Bolshevik communism, this corporate fascism, and this surveillance state. So we need to push harder. And I would rather live in a country that's inherently warm if I've been forced into this kind of existence. And I don't want to be in a nation that has got an overvalued perceived first world valuation and is actually now going to be harshly devalued when the debt genies come to roost. And the biggest one is America. Everyone thinks it's the cleanest, largest, dirty shirt. It is the dirtiest, largest, dirty shirt in the laundry. It's a trope. There's lots of tropes about America. Hegemons, by virtue of definition, export more paper than anyone else, and they have. And that is dollars and fiat and debt. They stand on the highest ladder. When that ladder falls, they fall from far higher up. They break their back. European nations are not as high a ladder, UK not as high a ladder, but you will fall too, and it will be hurtful too. And then you pick up the pieces. The quality of life will be greatly reduced. The tax extractors, the power that government has assumed. Gone are the days where governments were afraid of their citizens. We now live in a world where citizens are afraid of their huge, massive governments who threaten them regularly and are busy lining you up. That trial balloon on unrealized capital gains, they will float that thing for real in your country. That's why they're testing it, and that's why they're testing it in your country. It is coming, and it'll apply to your gold, your property, and everything. And they debased the fiat to make the phony gain that they're going to tax you on. This is property rights being destroyed in front of your eyes. You should leave, end of, and you should be in a nation where those are less aggressive. Which is cheaper to live in, that you can buy yourself a higher standard of living and will actually float up whilst the West goes down. That's my take. It really is. I mean, I'm doing reset rants here, and with two traders. I'd love to show you the Korean won trade if you want it, but when you bring up the unrealized capital gains, it's just like a red bull. It's a red flag to a bull for me. It is communism. It is absolute disrespect for you. It is absolute governmental disrespect. It is asset forfeiture.
The reason why I want to bring it up is because it's such a fundamental, important topic to discuss. It's not about the only thing, which is the 36%. It's just about the trajectory the government is heading to in the entire Western Europe and the US. But I wanted to touch your brain on one of the things that you will feel as you're against the entire sentiment, which is mortgage rates have gone up since 2021. Interest rates have gone up. But in the same period, the housing prices have gone up substantially too, especially in Amsterdam.
Not
they
in
still
Goldbound.
keep going up. No,
Not
that's
in
true. But
Goldbound.
I'll get to my point. The reason is the housing markets are just fake anyways. They are balloony, whatever they are. But if you are renting a property, which I am, and I haven't been buying a property because I feel like the markets are going to go through a big crash. I feel like it's comparable to any period like 1929, what's going to ahead of us, what is ahead of us, especially with the amount of inflation that we have and the rush of people going into properties. What would you tell to someone that is still renting at this point and everybody is shouting at them to buy properties because it has always been going up?
So having one property, which is your personal home, I can understand the emotional aspect to having that. Being able to put your stuff, nail things to the wall, the greater freedom and all of that. But right now is not a good time to buy because you're about to experience the single biggest bank crash, debt crash, and the withdrawal of consumer credit. So the prices people will be able to afford to pay, you'll almost be going back to an equivalent of a cash payment system at the lows, and then very minor, very moderate mortgage lending by very unenthusiastic banks that will be charging ridiculous fees at the lows. So being self-financed is going to be key. And the prices you pay will be a lot lower then, and those citizens will be locking in negative equity and be owned by the banks, and be bumped into forced expensive rental payments that will also include paybacks for their negative equity on what they borrowed. That is what you face. Or forfeiture entirely of the property to Blackrock, and then not being able to afford to rent it and having to rent a trailer park because that's the only thing that's affordable. We're going to see real living standard reductions because what you have right now was based on a fraud. It's based on excess fiat and debt proliferation. That means asset prices got passed on far too high, and the ability to borrow against them was far more extensive. Now, I would say America is far worse in this, and the leverage is far higher at consumer credit level than it is in Holland. But Europe is still not good in that area, neither is the UK. But America takes the toast. I know people with 9-year mortgages on cars and a 60% balloon payment. So I mean, I can't even begin to fathom that. But that is the usury extractors taken it to the umpteenth degree to turn people into complete serfs in their own home and trying to live beyond your means, acting richer than you are. Whatever vanity that led to people thinking that was moderately sensible is going to come back at them in spades. And those assets will be marked down. They'll be stunned to what they'll have to let them go for. And listen, I'll be there with cash, ready to pick up anything I like cheap. But I'm not here to be a vulture at other people's pain and expense. I'm here to try stop you from being in that position in the first place and tell you how to prepare for the likely unraveling of those events. And I don't think it's Bitcoin. I do think physically held items will hold you in good store, but they are going to try to squeeze you out of them. They're going to tokenize. They're going to want you to tokenize. You may have to go dark on that. They're then going to say, well, you made a bunch of money on that. Now that we know how much you got, we'd like to, extract it, and then you're a forced seller of your gold to pay the tax on your gold. So, and they're going to be doing even more in the digital space. You just have to watch Carstens, the rather slim chap at the Swiss bank heads, telling you about all the stuff he's looking forward to bring and how you can make money disappear if it isn't spent, when you need inflation, how you can restrict its use. This is an absolute power tool for them, and they're unembarrassedly delighted by this new tool that they've discovered and are bringing to bear, and you're going to be at the receiving end of it. And that is really dark. So once again, build wealth, get out of the banks, pay off all your debt, secure that wealth, secure it in gold, silver. I will trade and I will be in certain tokens as well, because I think they'll move them, not because I think they are friends, but really we need to spend cash and encourage vendors to take cash, and even in silver and gold, encourage them to take that. But we all think, oh, that's our best money, I don't want to pay in that. Well, you're then turning the worst money into the utility by continually using it. So it's time, if we want better money, we have to use better money to actually get it to catch on. And that's a thought as well I'd leave you with.
Before we continue, this is the chart of Ethereum. And if you were holding and investing into Ethereum over the past 4 years, you would have had no return. And that's why I've built MN Fund, which is a AFM registered fund in the Netherlands that is profiting from volatility. Whether the markets are going up, down or sideways, it doesn't matter. As long as it's volatile, we generate a return. And that's why in the past 8 months, we have been able to do it better than Bitcoin by more than 40%. And this product is designed for someone that is looking to invest into the crypto markets, but doesn't understand the complexity of the markets as a whole, but sees the opportunity of the entire asset class. And that's why we've built this entire fund with 3 baskets, which is we invest into protocols that are fundamentally strong, we trade the volatility with the automatic trading systems that we have, and we do OTC trades with foundations to support those foundations. And that's an interesting setup for anyone interested to invest into these markets. If you're interested into the fund, make sure to go to our website or reach out to me on LinkedIn or on Twitter. I'm happy to chat to you and assist you with any questions that you have. Well, if you see what's happening in Dubai right now, it's just a speed run of what is ahead of us in Western Europe. I mean, they have been brought into the situation of Iran. It's devastating. It's not great. But the prices of real estate have gone down by 60% in 2 weeks because it's just like one sort of bubble that is being orchestrated in that particular area, which is very likely to happen in Western Europe at some point as well. Not because of a war or whatever, but because of other reasons, the prices are going
Credit.
back towards the mean. Yeah.
The reason will be
Now-
credit in debt markets.
Yes. You've brought on Bitcoin. I use Bitcoin valuation against gold quite a lot because if I look at the current valuation of Bitcoin versus gold, and especially the indicators, they are hitting the same sort of triggers as during the bear market bottom in 2022, as during the same period in 2018 and in 2015. And you can clearly see that once gold is going to stall for a little bit, you can see the rotation happening into Bitcoin. I don't know if it's an actual rotation, but it's kind of the risk off, risk on discussion that you can see. And especially during this month as well, gold is correcting a little bit, Bitcoin starts to bump up. And I want to see why you are seeing that Bitcoin is not in the category of gold and silver, and what you expect from Bitcoin in terms of, well, not really price expectations, but going forward from here if you see gold act in that range.
So the difference between Bitcoin and gold. Well, let's just have a look at the chart and you'll see what pivoted for Bitcoin. If we divide Bitcoin by the gold as you were showing in that chart, you initially had, when a very low market cap valuation, the ability to move a very small cap and the amount of capital needed is very low to create the impression of major market cap appreciation. You have to remember, in the first few years of Bitcoin, a very small amount of the total Bitcoin was made available. You just have to bid that up to a few $100s and then multiply it by 21 million, even if 21 million wasn't out. And you would already pre-valued all the tokens that hadn't been. So market cap is a trick. It's a trick. The only available Bitcoin was what had been mined at that time in 2013, not or 2010 or 29, and we've been a bit fooled by this. And as more of the Bitcoin has come available, it's become a lot heavier a chart and much harder to make the progress that everybody became used to. It's kind of self-evident, but many people don't realize that market cap is quite a poor measure and is easily manipulated. I can start a family business. In fact, Elon Musk is attempting to do this with SpaceX right now and is bullying the NASDAQ, if they want his listing, to have him list a rather small percentage of the shares and have it instantly valued at 1.75 trillion by market cap. And this is, I mean, you and I could have a family business and you could be my brother Ned, and we could, we could hold 95% of the shares. And if you only put a 5% float up, and we can then buy that up to $100, listed at $1, and buy the remaining 5% up and create a steady bid under that, we've then technically valued the company at $100 by all the shares we own, including the 95% that wasn't listed. So there's a bit of a fraud in that market cap calculation. And Bitcoin's fallen a bit towards that. This period, this is unlogged, Bitcoin divided by gold. And you can see it was easier in the earlier days, although very volatile. You got this nice setup. We traded that to the long side. We've not been perma bears on Bitcoin. We've said very bullish things about it in its earlier stages. But to me, this has never been about your liberty and freedom. And it's quite clear how the messaging has changed, that all the wrong people are in charge. World Economic Forum leader and massive asset manager, fan of tokenization, Larry Fink, as one of the big players in ETFing Bitcoin. These are not your guys. Epstein are not your guys. You made a 69. You've only made a little bit higher. The highs on this have gone from being a lot higher, to only marginally higher. And then the lows, what's happened is you're originally here and now you've absolutely puked and you've dropped. So this points to the fact that the central banks are in fact the biggest determinant of what's real. and they aren't buying Bitcoin. The real first world nations and major nations of trade, you can take your El Salvador, you can take anyone else who says something positive about it, but China is not buying Bitcoin. They're settling their excess trade deficit in gold. America is exporting their gold to the East. The East, for which the money is all moving, for which the gold is all moving, is not buying Bitcoin. The central bankers in China are not. The Japanese may, if America bullied them hard enough, but they're not currently. The other nations are not buyers of this narrative. They seem to treat it as a bit of a CIA Mossad project. There's been a lot of OGs that have sold in the last 13, that have held for 13 or 14 years. And you seem to have Michael Saylor and Jack Mallers as these treasury guys that seem to be providing exit liquidity with borrowed money. That to me smells of major Enron. Now, I know this is a crypto channel, and I know I'm going to be hated for this, saying this, but I'm going to tell you exactly what I feel. This is not a winning chart. This is had your best moments already chart, now reversing badly. This is a green candle, but it doesn't fix 1, 2, 3, 4, 5, 6, 7 in a row months back. And this is major first world serious nations buying gold, not Bitcoin. It's a hard and ugly fact. I'm sorry, it's bad news. Okay, you can hate me or you can see the facts. That's the data. That's the chart. And the ability to outperform cycle to cycle has got far less. You hit a high of 40, you're at about 37 ounces the last time. That's not much of a change. In dollars, yeah, you're impressed. Forget dollars. That's not a serious unit of account. It's a monkey on a greased pole. Same for the euro, same for the rand, same for all the fiats. Every year, there's way more of them out there. That's as if you're at Bitcoin and there wasn't 21 million. You aren't comparing to something that's in perpetual proliferation. You're talking about something that has some degree of finite and is mined at about 1.1% a year. It's not capped like Bitcoin, but you're finding it about 1.1 to 1.5% a year. You're losing. You're losing against that asset. And the big money that moves markets, that is usually the best informed money, is not supporting your thesis. That's called a belief system if you choose to ignore that. And I know you had Lynn on, very smart, very eloquent lady, and the other gentleman that's very strong on Bitcoin, what was his name again? I had him on my channel once. Say again?
Jeff Booth, you mean?
Jeff Booth. I had him on, and I'm sorry I wasn't buying what he's saying. Wasn't buying it. He's very eloquent, and he's very smart, and he's all about the technology. I'm sorry. The minute money is digital, there are footprints on a server that tracks that transaction. Me putting notes in your pocket and saying, go take your wife out. I know you've had a tough week. Here's 100 euros. Go have yourself burger and chips. I don't know if you can, what you can get for 100 euros actually anymore in Holland, given what's coming. But hopefully you can squeeze a dinner in. Not too fancy though. That's between me and you, unless you choose to tell other people and I choose to tell other people. The minute we create data, money is now being tracked. Even if it's Monero that focuses on security, you're going to create smoke screens, but you're trying to hide footsteps that are on a server now. That's captured. Wallet into that wallet. So if
you look at the chart before we continue into tokens, I just wanted to ask you one question, which is, in hindsight, every moment when you buy a certain asset, usually the chart looks absolutely awful. If you go back in history in 2022 or 2018, Bitcoin versus gold, Bitcoin versus the dollar, nobody believed in it. There was only negative sentiment. It's kind of the same right now, and that's usually shown as one of the best moments to be buying into that particular asset. The same story for gold. The same story.
No, what you're saying is every low leads to a high. Buying at a downtime, every low. Well, it didn't work on Enron. It didn't work on subprime issuers. Doesn't work on a lot of things. Some things come to an end. And to me, the seriousness of Bitcoin, if you just look at it functionally, compare it, okay, and many people don't take this crypto seriously, but Tron, for example, as a low-cost, fast, utilitarian mover of money. It's faster and cheaper than Bitcoin. But Bitcoin as gold, well, the central banks aren't buying Bitcoin as gold, they're buying gold. So if it's not a store of value, it's not a utility of a medium of exchange to the same competence as other options, and it's not just Tron, XRP, any of the others that exist, insisting the first software option is the ultimate. I would still be riding a penny farthing bicycle and driving a Model T Ford. It is, unfortunately, I think, Bitcoin is served its time as an on-ramp. I don't know what happens with it price-wise, but I wouldn't take the risks. The risks, the asymmetry of risks that it could go completely is higher than people are pricing in, the average Bitcoin is pricing in. And the need to just manage that risk, you should have a 10x, and the ability for that risk that it could go to zero, you should have a 10x, and it can't easily do that. It's got to go to from 120,000 to 1.2 million, and that would put the market cap at something unbelievably ridiculous. And I'm sorry, all the debt markets that are deflating are not running into Bitcoin. We've quite clearly seen them run into other assets for capital preservation, and that is gold and to some degree silver, which has a real physical shortage, not a by code manufactured engineered shortage, and those things matter more, and that's why Trump is talking about grabbing Greenland and Venezuela. They want you in the virtual world, they want you in the digital world, whilst they're grabbing oil in Venezuela, embargoing Cuba, and negotiating to get Greenland. Why? Because they want physical, actual things. Not a logo with a B on it. I can't hold a Bitcoin, and everyone go, but that's why it's fast, that's why it doesn't do this. We go back to the analog versus digital. I'm not anti-progress, and I can see digital coming regardless whether I want it or not. I personally would rather do without the digital money, but it's going to get forced on us anyway. I just don't see a Bitcoin as a winner in that situation, because it doesn't have a unique reason. Being first isn't good enough. Saying we're limited, other coins are limited, and there's just the ability to do things faster and better, and by utility as well. So I push back against Jeff Booth and Lynn Alden's hypotheses. I think it's a secret service dark state creation, and I think they're selling out. And these treasury companies are the dumb liquidity that's buying it. That would be my theory. Can I prove it? No. But I don't think the upside potential of Bitcoin at around 70,000 is anything that I would risk the chance of it going to zero. If it goes to 85, is that good? To 120, is it worth losing everything? Where do you put your stop loss? It's clearly losing ground recently. You can try call a bottom on it against gold, but gold is my unit of count, because it's been a unit of account long past 3,000 years, 15,000 years. If you want to get into the crypto space, I feel there are others that are technically set up that actually look like they could go up. And it's not Bitcoin that is looking that way. Even though Bitcoin overperformed this short period, that wasn't much of an old cycle. I think the status ISO tokens that tell you they're going to be, that have always set out to be the banker's friend, never pretended to be about liberty or anything. Those have been anointed and probably chosen, and they're busy loading up our future financial system, and they could indeed do very well. I don't know where Bitcoin falls when that materializes, but I don't feel it's worth the gamble.
I mean, you mentioned that you're going to be looking at crypto tokens to trade that, but I think I want to make it a little bit broader, which is, if you look at the current markets, then gold has gone up, silver has seen a big run, precious metals and the entire category is doing really well. Bitcoin is suffering quite clearly. Indices have not moved for nearly a year. Which crypto tokens do you think are the ones that you're going to be trading? Or broadly speaking, if someone is listening or wants to build their own wealth, what are the asset classes for the upcoming 6 to 9 months that you're looking for in terms of trading?
Yeah, so I am expecting that they're going to try and nudge us into digital money, and the way they'll do that is banking collapses and restrictions of access to our capital. So what's happening on private credit to private credit investors is likely to happen, in my estimations, in terms of banks. So you'll have limited access to your bank money. And the better treated money will now be stable coins, USDC, USDT, and it'll be easier for me. There'll be less overall control. Although at the exchanges, they're still going to have this KYCing thing. So there's going to be a nudge out of banks into this digital environment. And one of the tokens fundamentally and technically that looks well set for that, I mean, many of us don't recognize, but outside of the Western world, Tron is doing exceedingly well in terms of it. I don't take its leader, Justin Sun, seriously. I think he's a front man, just like Elon Musk is a front man, and he can clown around as much as he likes. But the fact of the matter is, in Africa and in Asia, Tron is the primary chosen chain. It is considered one of it's got a real dominant position in most, and in Latin America. It's actually North America and Europe it's just one of many. They utilize it a great deal for onboarding, and it's the stable coin which will be the CBDC. Remember, they want a currency that they can devalue slowly to diminish you all the time. Their goal is always been inflation so that they can debase your money. That keeps you poor and keeps you having to run on the treadmill faster. And that gives them power to excess spend and put the cost of that excess spend on you by diluting your currency. It's a very simple trick, actually, that all power structures, multi-generational power structures, and one of our key themes that we share is they will never let you have your own money. The whole world of millennia in terms of power and history is they must control the issuance of money. So understand that, and then tell me why Bitcoin would be allowed to survive and not contained, and you would even have someone like Larry Fink semi-promoting it and doing ETFs for it, if it threatened the power structures truly. It doesn't. It clearly doesn't. So there's a plan for it, and you're not privy to it. That's point number one. Tron, for example, as I mentioned, technically this is very interesting to us. So if I take you to TRX USD, it even comes in before the likes of XRP. This has shown consistent strength and building even in bear markets by the same measuring benchmark, XAU USD. It's actually been surprisingly robust, even with the rebasement of the gold move. We have a technical setup that we've drawn with our HVF indicator, and it is still live even against gold ounces, and it's currently rallying. So let me just put that on log scale. You can see this, and as an overall move, and I'm just going to multiply this by a couple of thousand because we've got such small numbers, because obviously Tron is in cents and gold is in thousands. So I'll just multiply that by 10,000 a little bit. So you can see we're at about 0.52. This is an active potential trade, 0.52 and going to 24.8. So it's not even one, it's half of one. So that would be 1 to 48. That is a massive multiple of overperformance to gold. And it is quite compliant with our HVF theory. It broke out. You got the XRP run. It got a little bit of a pump. It made the first interim target. It's then come back, bounced on our funnel, and it's had this soft period where crypto has just been awful, and it's now returning up. Let's have a look at it in the dollar. Now, I remind you, dollar is monkey money. It's absolute monkey money. Not my monkeys, not my circus, but it's monkey money. You can decide if you accept monkey money. I don't. But let's just, for the record, because most people don't recognize gold as a unit of account, they accept willingly the monkey money. And I'll show you it against monkey money. That's it on Binance. And this particular structure is doing rather well. And again, it's on monthly. I might just move it to 2 weekly because that's a bit granular chart. And you'll see that that's in a macro technical setup. Mm-hmm. This is, again, a volatility squeeze, asymmetric rewards. It triggered, it made its first interim, and this is a winding up squeeze right now that is happening. And it's coming off those lows. So we think it runs that second interim target, and at some point it'll run $6.60. But that dollar won't be buying you what the dollar does today, because we are going to go into a, slowly at first bankruptcy curve and suddenly very fast, that convexity curve. I should have done it in another color, so I'll do it in another color, but that's your dollar, originally starting at 1 and going like that. And that's why gold will do the exact opposite of that. It'll do a parabola. And the truth is, it's just gold holding its value. You have two charts. The slowly at first and suddenly very fast. Ernest Hemingway's response to how did you go bankrupt? That's how we are going to be acknowledging the debasement in our fiats. Suddenly, very, very fast. And you'll think, where did this come out of? It'll be super normal. Well, you're busy watching the supply chain choke that is going to lead to all your products going up in price. And you're going to need more money. And they're going to say it was all Iran. It was all, we had to deal with a nuclear threat. It was the cost of dealing with the nuclear threat. That's why your oil price has gone up, your heating has gone up in winter, and all of these things. So there's quite a bit in there, but this has made steady progress, showed real strength in a weak bear market period, did this descending triangle and then traded up. Bitcoin continued to trade it down. It's got a negative inflation rate. So that's a technical example of a token. This once was at 26 on the market cap, and it stormed into the top 10. You know, it's just behind Sol. It's at number 8 now. So, you know, that's quite some progress in a time of, it's overtaken a lot of stars, a lot of people. You take the leaders, Charles Hodgkinson of Ada, an earnest, sincere guy, smart, always updating, communicating with his message. It's gone nothing but down. And we saw that in the charts. We said to Ada, friends, it's going out of the top 10. Sorry, it's going out of the top 10. This was number 4 and 5 at one point, out of the top 10. And that Tron was coming into it from way out. Tron is now above it at 28 billion. Ada is now almost a third. You know, it's a third of Tron by market cap.
Yeah.
Think of that. Charles and all of his thing. It's a third of Tron. And it's now jumped Dogecoin. That's Elon's friends. And it's twice it. It's absolutely twice Elon's friends. So actually, it's quite respectable progress, and it keeps chipping away. You take out the two fiats, stablecoins, and it's behind Solana, BNB, XRP, Bitcoin, and ETH. Bitcoin and ETH, 1 and 2, you know, that's it. XRP is the third one. Binance has been stubbornly strong. Many people don't like it because it's an exchange. I've highlighted that technically it's consistently shown there's support for that token. And we've continued to say, if you have to hold on, hold Binance, hold Tron, and long run, we see potential in Monero to come up when privacy starts to become more recognized as desperately being sacrificed by this entire system. That's a fundamental comment, but we've also seen it technically. So yeah, that's where we're at. It's proving very hard for Bitcoin to go above 1.5 trillion and stay there. And you've got to remember, gold's gone from 15 trillion to 30 trillion. That's a lot of trillions that didn't go Bitcoin's way. You know, with Bitcoin at 1.5.
That's true. That's true. And I think there were a lot of great tips for people that are watching. And I think BNB has been one of the strongest assets. TRX has done really well. I think the privacy topic has been taken into account I think it was Q3, Q4 of 2025 that it really started to pop up, and it will just be bigger also with AI. But we need to round off the show. I can speak to you for hours. I'm sure we will be speaking on the podcast channel in a few months or in a year from now. But before we round off, if people are looking to get more info from your side and learn how to trade the markets in a technical way, where can they go to for more information?
We've been very well supported by our Dutch friends in our community, and there will be other Dutch people that you'll meet in there, but that's not the reason to come. The reason to come is that we're going to help you in building wealth when you've never needed it more. It's not wealth for greed's sake. It's not wealth for show off or fancy car sakes. It's for securing yourself a better quality of lifestyle in terms of what is coming. And sadly, most people are not seeing what's coming. It's going to be an entirely polarizing event. And there'll be a few that took the right steps and that insulated themselves far better from the processes that are being effected. So build wealth, secure that wealth, and multi-jurisdictional optionality and arbitrage for your existence, which means you can choose where you have homes in multiple places. And many people can't see that right now. They don't even have a home in their own home. But it's amazing how quickly, once you start making progress, things happen. In 3 to 4 years, you can have moved on quite substantially. We overestimate what gets done in a day. We underestimate what can be achieved in a year. And that's what HVF method is all about. Getting a couple of big macro trades and taking them to their fullest, securing those profits, securing that capital, and utilizing some of it to lay the groundwork for a multi-nation state existence. Stop thinking in terms of countries, actually. They don't at the very top. They talk about regional blocks and control of doing this and that. We shouldn't be nation stating. If you want to find out more about how we can help you build your wealth, secure your wealth, and also secure your optionality in what I would consider a reset season, pop over to themarketsniper.com, either the website where there's booking links to talk to us, or our YouTube channel in the notes where you can find out more, or just subscribe and follow and see if you like us. We also have a free mini series on our trading strategy that give you a heads up on why the best method is the volatility squeeze for the asymmetric breakout move with a really tight, the one time, because most stops often harvest you, scalp you losses, that you can get away with tight stops. So that is also available, that mini-series, in our YouTube, listed in the show notes. Thanks for having me on, Michael. Great talking to you. And yes, I'm sorry for the rant. I hope the guys enjoyed it in Holland about the unrealized capital gains, but this is peak disrespect, and the government needs to learn to fear its citizens again. And right now it's completely the wrong way around. And I'm afraid I don't think you can fix it. That's why you not only push back at home, but you also build plans offshore.
I think a lot of people have, listened to your rant, but also are feeling the exact same thing. So it's good that it's out there and that other people are sharing their opinions on this topic. So that has been really helpful. All the links will be in the description beneath. Once again, thank you very much for joining us. Next time, when I'm going to Cape Town, I would love to do this in real person with you somewhere in Cape Town in a podcast studio or on a veranda or whatever. But thanks again for joining us.
We'd love to do it.
Probably in the winter.
Not in winter. Yeah. We fair weather friends. we follow the sun.
All right. Thank you very much, Francis, and have a good day.
Same to you. Thanks for having us on. Bye-bye, Michael.